What's going on, guys? It's going to be another video about investing tips and investing clarification. So in this video, I'm just gonna talk about the different kinds of investing vehicles that we have nowadays. That includes stocks, bonds, savings accounts, ETFs, index funds, mutual funds, real estate, and etc. With all these different kinds of investing vehicles, it gets kind of confusing because sometimes some definitions, they sound vague and also they sound somewhat similar. First, I wanna start off with stocks. So I think stocks is the most widely known investing vehicle because it is most widely talked about, and that is basically just a share of a company. So stocks, shares, they're all the same thing. So all that means is that owning a stock or owning a share of a company means that you have a partial ownership of that one individual company. So if the company does well, you do well because you are a owner by owning that stock. If the company does bad, you also do bad. One great thing about owning stocks is that a lot of stocks, a lot of companies, they give dividends. So if a company, if they have a profit for that quarter, for that year or whatnot, then they give it to their shareholders or their stockholders or their owners a piece of that profit. And that is called the dividend or the dividend yield. I will get into another video about how dividend yield is calculated and why it is a good or bad strategy and so on. Next is a bond. Stocks are considered more risky. Bonds not so much because bonds are usually done with a government like the US government, which is considered more safe than a company because a government is much bigger than a company. They have more financial backing. So in general, a government is more safe. Usually the way some portfolios are designed is that you have some stocks, and to hedge the risk because you've invested in a stock, you also invest in bonds. So bond is basically like an IOU. You give some money to the bonding company. So let's say the government, right? You give some money to the government and they will say, okay, I'll give you back this money with interest on this date. That could be 4, 5, 6, 10 years. And that is called the maturity date. So bonds is fixed income. Like exactly what you're gonna get because when you buy bonds, you know the rate, the interest. So it's called fixed income securities. A lot of the mortgages, they tend to be packaged up into different bonds because they're usually fixed income because they have a fixed rate interest rate. But that is not comprehensive because you could also have variable rate bonds. Like if you have an ARM loan, your adjustable rate loan, then you have adjusting interest rates. Next, I want to talk about a mutual fund. It is a basket of stocks which is actively managed by a mutual fund manager. Back in the 1900s, a lot of people realized that it is quite risky to pick 1, 2, or 3 stocks individually because if that 1 or 2 stocks or 3 stocks, if they go down, then there goes all your money, right? So to diversify your risk, really hedge against your bets, they said, okay, how about we create a fund which has a basket of stocks, so anywhere from 100 to like 200 stocks, so that if one company goes down or 10 companies go down, not all your money is lost because your money is invested into 100, 200 different kinds of stocks. So that fund manager is the guy or gal who decides what's going to be inside that mutual fund, inside that basket of stocks, so that your money is diversified, so that your risk is low, but your returns are still decent to high. One big downside about mutual funds, although they are very popular, is that they have high expense ratios or they charge a lot of fees. Because it is being actively managed by the fund manager, they tend to charge a fee. Again, this all depends on the mutual fund itself, but typically I'll say it's anywhere from 1 to 2%. It may not sound too bad if it's like $100, $200, but when you're going into the thousands, hundreds of thousands, it's a lot of money. So that's a mutual fund. It's a basket of stocks and it is very popular. In fact, a lot of by default 401k plans are usually in mutual funds. Next, I'll talk about a subset of a mutual fund called an index fund. Now, this is my favorite because an index fund, it is similar to a mutual fund, but what it does is that it tracks an index. And what I mean by that is instead of having a bunch of random stocks of all different industries like a mutual fund could have, an index fund is more specific. It's gonna pick a specific industry, let's say the S&P 500, right? Those are the 500 best performing companies in the last 10 years in the United States. So it is gonna track that index and it is very passive. So if that index does well, then this index fund is also going to do well. Just like there's an index fund for S&P 500, you have index funds for bonds, emerging markets, real estate. You could have index fund for anything and everything. Gold, silver, even water. So it is like a mutual fund, but it is way more specific in that it tracks a certain industry. And if that industry does well, the index does well, so do you if you have invested in that index fund. And one amazing thing about index fund is that it has significantly lower expense ratio than a mutual fund expense ratio or funding fees. Just to give an example, like I mentioned before, for mutual fund, it's pretty typical to have a 1 or 2% fee. For index fund, it is pretty typical to have an expense ratio of 0.16% or 0.12%, especially if you go with Vanguard. So index fund is my favorite because you're still diversifying your portfolio because it is tracking an index. That index is representing many different companies, many different stocks, but you're not paying so much in fees. And you could literally pick different index funds so that you have a good representation of different industries in your portfolio, okay? And it is extremely passive. It will not make you rich overnight, most likely, but if you consistently invest in it over and over again, monthly, day in, day out, in the long run, it will make you awesome returns. So next, let's talk about ETFs, exchange traded funds. So exchange traded funds are a subset of a index fund in that ETFs are also representative of index funds, but ETF are more flexible, as in you could sell it and buy it like a regular stock. Index funds and mutual funds, they're not usually in the exchange from like a New York Stock Exchange or NASDAQ, something like that. So it's not bought and sold easily, mutual funds and index funds. But ETFs has that security feature to it, because with index funds and mutual funds, you could only buy and sell at the end of the day, whatever the price is after the closing bell. You cannot buy and sell index funds and mutual funds throughout the day. It is not a security like a stock, but an ETF, it is like that. ETF represents an index fund, but you can buy and sell the ETF like a stock throughout the day. If you do not want to buy and sell stocks, but you would rather buy and sell indexes throughout the day, then ETF is the way to go. But with ETF, the expense ratio is higher than an index fund. So if you are not a passive investor, then ETF might be the way to go. But if you are a passive investor, I would recommend mutual fund or a index fund. Next, CDs, a certificate of deposit. A CD is pretty much a IOU in a way to any bank. The interest rate is very low. You give your money to the bank for a period of time, let's say 1 to 5 to 10 years. And the longer the term is, longer the time is, the more interest you get in return. That's another investment vehicle to make some guaranteed safe money, but they are usually very low. You'll be lucky to find anything above a 2.65, 2.85%. Certificate of deposit is pretty much you giving your money to the bank, and the bank uses it for their own investment for a period of time. And then after that period of time, it's called a maturity date. They have to give you that money back with some interest on it. Next, savings account. I think most of you know about it. A savings account is like a checking account, except your interest rate in the savings account is higher than it is in a checking account, but it's still very low. It's extremely low. I think it's like less than 1%. So obviously it is not a good ROI, but if you want to have some emergency fund, accessible, extremely accessible, so maybe instead of putting it in a checking account, you may want to put it in a savings account if you want to, gain some extra interest on that. And they have some limitations as to how many times you could transfer money from your savings account to your checking account per month. I believe it is 5 times, but I could be wrong. Do your own research, but I think it is 5 times from what I remember. Next, real estate. This is my favorite. It is literally you buying real estate, like a house, a condo, apartment, a townhouse, and you put some down payment if you have to, and then collect the rent paycheck. You have a tax shelter, and then if it appreciates, great. Doesn't, you still are getting rental income to pay off your mortgage, which gains you equity, which is another form of ROI. That's another thing. Again, I'm not gonna go too in-depth into it. I could talk about real estate for hours, and I have many videos about real estate, so just watch those. Next, this is pretty modern. It is peer-to-peer lending. Also, this is modern in the sense that now it is all digitized. Before it was done face-to-face. Peer-to-peer lending is pretty much you giving money to another person, and you are in a way not going to the bank at all. There are websites like Prosper, Lending Tree, where you put your money when someone else needs it. It could be anyone, and you could get ROI from 5 to 10%. But in my opinion, I think it's a bit risky because I don't really trust like individuals like as much. Like, what if they don't pay you back? I don't know all the consequences if they don't pay back. Like, I haven't looked into peer-to-peer lending as much, but just so you know, there is peer-to-peer lending. Lastly, I don't think too many people, not the average person, actually invest in this, but I know it is still an investment vehicle. It's art. I know a lot of rich people, to park their money somewhere, they will buy art, like classics from Picasso or Degas. They park their money there because art, like good art, classical arts, they tend to appreciate. So if you buy something and it's going to appreciate, that is in a way the definition of a good investment, right? So art is another thing. That is all that I could think of, all the investment vehicles that I could think of right now. Obviously, there are many different kinds of other vehicles, but I think these are the most common ones. So yeah, let me know if you have any questions, if you want some more clarification in anything that I mentioned. I will try my best to make another video addressing those. Like, share, and subscribe, guys. More to come.